I want to go, before we get to your price target and what you see ahead and the whole question of distributed energy, I want to see whether I'm understanding correctly what's going on in the marketplace. We've got supply problems in many parts of the global economy. Is supply fundamentally the reason, lack of it, fundamentally the reason why energy prices have gone up as much as they have, and why you see them continuing to be at this level? Are there supply constraints in the equation?
That's an important question, Tyler. And if you actually look at energy, I would differentiate power, gas, from oil. In the case of oil, we still have OPEC spare capacity. They're not quick to ramp up, but it's still there. I think on the energy, call it gas and power side, it's been supplied to some extent, outages in coal, in LNG. But I think probably the most surprising driver has been the demand side. When you think energy and COVID, you think people not flying, not driving. But the mirror of that is people at home consuming more electricity. It's less services, more industrial activity. And so really, power demand this year has surged ahead. Chinese power demand year to date is up 13% relative to last year. And so that, faced with some supply issues, is really propelling prices higher. Now, what is key, though, is supply will become an increasingly bullish factor in the years to come. We're starting to see signs of that binding underinvestment. Take LNG, right? We need that gas. It takes 5 years to develop a project. That's the next leg of that energy move, from a winter seasonal shock to a more persistent reflation of energy prices for the whole economy.
Energy, let's talk a little bit about energy underinvestment. In other words, because I would guess because of the push toward cleaner energy, toward non-fossil fuels and ESG, there has not been an incentive to develop projects like the ones you just mentioned, which are development and exploration and drilling projects. And I suspect there has been a similar dearth of projects on the utility side. I don't know when the last gas-powered plant was built in this country after a period in the aughts and in the early part of this decade when that's all that was going on.
So that's a clear and important driver, right? We've seen investors in general shifting their portfolio to target ESG criteria and goals. And that has left less investment for your traditional hydrocarbon sources of energy. That's the first one. And you can think of it as it's a higher cost of capital, right? You need to attract investors with higher rates of return to compensate for this structural reallocation. It's actually only, however, the second driver in terms of importance over the last several years, because this underinvestment theme has actually started already in the previous decade. And it really reflected energy companies, mining companies overspending on big projects for a decade. And if you think about shale in particular, right, it was targeting growth for growth's sake, not shareholder returns. So even before you overlaid an environmental concern, you had already pushed those investors away from the sector, driving underinvestment.